Hello and welcome to Pro Trader Strategies market commentary for Thursday, January the 2nd. Happy New Year to everybody. My name's Eric Wilkinson, and yes, you very well may recognize me as the Wolfman on mainstream media. I'm here not only to talk about the markets and how those are impacted by the economic data, how all of that goes together to come up with an assumption on our directional bias, but how we can take options and increase our probabilities of success by using those rather than just going out there and buying or selling a stock willy-nilly. All right, so without further ado, let's get on with the economic data. I talked about this early on in the week before last year. I talked about this, the PMI data that we're getting out this week. We're getting a lot of PMI data across the pond and here in the United States. Now, keep in mind the economic data across the pond on these PMI, which is Purchasing Managers Index, one of my favorite numbers to look at, is forward looking. But we really look for the flash estimates because it is an estimate of the final manufacturing PMI, and it's more of the same. Spain, Italy, and Germany coming in below below 50, I should say. 50 is the delineation of being positive. Above 50 is expansion, and below 50 is contraction. So all of those being the same, France being one of the outliers, being above 50 on the manufacturing sector. France and Germany are the main manufacturing sectors of the European region there. And then we got Great Britain's in line with expectations below 50 at 47.5. All right, and then we move back over here to the United States, and we got our unemployment claims in line with expectations at 222,000. Challenger job cuts in line with expectations there, maybe a little bit lower than what was expected. Not a great thing, but we're seeing a lot of good employment numbers. So I don't know that that one's necessarily out of the realm of what we would expect there. And we got manufacturing PMI here in the United States, which came in above 50 at 52.4. But our main economic data point for that one comes out tomorrow, and that's in the form of the ISM manufacturing PMI, and that's expected actually to be below 50 at 49. So we'll have to see tomorrow whether or not we can beat that. That would be a really good thing if we can beat on that number, because then we would not be necessarily staring a recession in the face. Although we do have now 4 of those below 50 in a row. The PMI for us, another one would really be signaling to many people that we are actually entering or have entered a recession here in the United States. All right. Let's talk about the overall markets. We've got crude oil coming off a little bit here today, actually off of the highs of where we started out. There was a lot of euphoria coming out this morning, and that's why a lot of these charts are looking like, you know, crude oil is down on the day. It's actually positive, but the chart makes it look very bearish. The reason why is because we started seeing some tweets again, and that's what this market's really been driven by quite a bit on the tariffs around China and the 15th, how those are going to go about. It looks very positive, so the market very bullish on that this morning. And since then, some of that euphoria has come off and profit taking going on. So markets are really starting to creep off, and even some of them near lows of the day. We've got gold futures moving higher. Not unexpected when we start seeing this pullback happening in the equities and some of the other main markets there. But we've got gold futures coming up and trying to test that 1533 area that I talked about, that I think that we were going to go up and test, despite the fact that we saw on Tuesdays rally and then come back. Here it looked like it was going to be a bit of a toppy pattern. I do expect still gold to stay between this 1533 and 1500 area, build out that volume node in and around where we're looking here. So not unexpected here to go up and actually test that Fibonacci before we start maybe seeing some more weakness in there. But as of right now, testing that market. We've got the bonds up over a point on the day. They've accelerated, you know, despite, we talked about this also, that we were starting to see maybe the 9-day moving average cross over the 200-day moving average. That was going to be more of a signal of longer term bearishness, and a settlement below that 200-day was pretty bearish. But Today we've got that rebound. Why? And it's really a reflection of money moving out of equities and into the bonds right now. And I do believe that bonds are really overdone to the downside. The Fed is not going to raise interest rates, you guys, anytime soon, especially with this looming manufacturing PMI coming out, and another one below 50 would really be a wet blanket on this market, because it would be a wake-up call to everybody that a recession is basically imminent. So bonds starting to react by that. VIX is still in negative territory, despite the fact that we're seeing some of these equities start to fall off. NASDAQ is in positive territory, but well off the highs. Something to note, this 82.52.5 is an overnight high. We tried to make that high during the day right off the bat. As soon as the markets open, we came up a quarter tick shy of it. So 52.25 is really where the high was during the day session. Since have seen some of that market come off. Actually, we're seeing more of a rebound now than what I was expecting to see. Last 15 minutes starting to see a bit of a rebound here. All right, E-mini S&Ps, you can see that the high is a couple of days ago there. We haven't made that all-time high intraday yet. This is what we're talking about with the E-mini S&Ps 30-minute chart here. You can see the overnight tweets happening, pierced that high, tried to get up there and print that overnight high, but then the euphoria came off a little bit. That's why I was expecting us to be nearer to the lows, because when I started this market commentary, we were near those lows and testing that 200-day moving average. Now, that's not the 200-day moving average. It's a bar on this one. So that 200-day is a little bit different than what we're seeing on the daily chart. So it's just an incremental product on that. But now starting to see a bit of a rebound after we retested that, and starting to rally up. That you can see that when we were near those lows there, if I pull up the low on the day, if I can hold on to that, 26. So you can see we were slightly in negative territory when we were on those lows there. So yeah, the low, now that I got it held on there, it's not going to show me 45, so that's the wrong one. So right there, 26. So that was in negative territory when we basically started this video. All right, so that's about it. Today's webinar is going to be a really good one, so check it out. We're talking about implementation of options into our portfolio. A lot of us have a 401k that we need to hedge. That's what we're talking about now. Not necessarily just day trades, but longer duration trades is what we're talking about, and kind of building out a portfolio in and around that. So I'm talking about how to hedge something that's already in an existing portfolio, and or building out a portfolio with a maybe smaller portfolio. Maybe you don't have hundreds of thousands of dollars in there where you can just buy a nice rounded out portfolio of stock. Well, this is going to allow us to use options in place of those stocks and still get the same type of performance. Okay, so a much lower ROI, which is return on investment, and that is key, especially if you have a smaller portfolio. So we're going to be talking about that right now. My portfolio is doing rather well. A lot of things working my way. Maybe Boeing's kind of being a thorn in my side. That we probably pull up a Boeing chart. I'm sure I have it. This 325 area is acting as much more of a support than what I was expecting. I was expecting us to go down and test that 300 level, which was the 52-week low. And we've had all of this bad news since with Boeing, since seeing that 52-week low. Don't know if that's still going to happen. We are in a very bearish trend here, so I'm going to stick with it for right now. I think that we still might go down there and test it, but we got to break below that 325 area before that's going to happen. All right, and that's about it. And stay below there. We've tested that, but rallied back above, to my chagrin, for lack of a better phrase. All right, so check out our webinar today. We are going to be working on a couple of good things there, and continuing on this, we're going to be working on a poor man's covered call today, and that is basically like a stock position. We're going to build it out like a stock position and then cover that to maybe limit our risk to the upside, but it's also going to limit our margin as well. So check it out. So if you can't take that, take it easy.